Hello everyone, it's Mike again. This video describes the accounting treatment of deferred commissions, which is a type of prepaid expense that we often see on the balance sheets of software companies. A prepaid expense, also known as a deferred expense, is an asset that represents the prepaid value of services that will be provided to the company in future periods. Even though the company has already paid for the item, it has not yet been expensed on the income statement because it has not yet benefited from the prepaid service. You can think of prepaid expenses as the value of services that you've purchased but have not yet used. Typical prepaid expenses include prepaid advertising, prepaid insurance, prepaid maintenance, prepaid legal fees, prepaid rent, and prepaid taxes. Now let's see how the accounting treatment for prepaid expenses affects the payment of commissions by Silicon Valley companies for generating sales. To illustrate this for us, I'll use Salesforce.com as an example. Here is the asset section of Salesforce's balance sheet as of January 31st, 2017 and 2016. In the current asset section of the balance sheet, Salesforce disclosed that it held $279 million of prepaid expenses and other current assets. Salesforce's assets also include $539 million of deferred commissions, of which $311 million were reported as a current asset and $227 million as a non-current asset. But just what are these deferred commissions? In its January 2017 Form 10-K, Salesforce states that deferred commissions are the incremental costs that are directly associated with non-cancelable subscription contracts with customers and consist of sales commissions paid to the company's direct sales force. It goes on to state that the commissions are deferred and amortized over the non-cancelable terms of the related customer contracts, which are typically 12 to 36 months. Thus, the current portion of the deferred commissions relate to the next 12 months of the subscription contracts, while the non-current portion relates to the remaining months of the contract. But why aren't these commission costs immediately expensed as compensation expense at the time the employee receives the payment? After all, Salesforce states that these commissions are paid within 1 month after the customer service commences, and the employee that receives the payment must certainly have paid taxes on this income that they earn. Salesforce's 10-K goes on to state that it believes that the accounting policy to record the commissions paid to its salespeople as a debit to deferred commission is the preferable method of accounting, as the commission charges are so closely related to the revenue from the non-cancelable customer contracts that they should be recorded as an asset and charged to expense over the same period that the customer subscription revenue is recognized. Thus, a deferred commission is similar to a prepaid expense. Salesforce's method of expensing the sales commissions over the same time period that the subscription revenue is recognized is consistent with the matching principle, which states that companies should expense its costs in the same period that the revenue generated from these costs are recognized. Well, how much in commissions were actually paid by Salesforce to its employees during the year? In the MD&A section of Form 10-K, Salesforce states that during 2017, the company paid $462 million of commission expenditures and expensed $371.5 million to sales expense. This means that Salesforce recorded more deferred commissions as assets during these years than they expensed as sales expense. Here is Salesforce's income statement for the 3 years ended January 31st, 2017. Recall that they reported income from operations of $64 million for that year. If they had expensed the $462 million of commissions that they paid during the year, instead of the $371 million of commissions that they actually expensed, Salesforce would have recorded a $27 million loss from operations, instead of the $64 million operating profit. The accounting treatment of sales commissions on subscription contracts by Salesforce.com and similar companies like Workday, is consistent with implementation guidance provided by the FASB in its May 2014 Accounting Standards Update regarding revenue from contracts with customers. In this guidance, the FASB presents an example where a company incurred $50,000 of legal, travel, and commission costs to win a competitive bid for a project. In its analysis, the FASB concludes that the legal and travel costs must be immediately expensed because these costs would have been incurred regardless of whether the contract was obtained. However, the $10,000 commission should be initially recorded as an asset because 1. The commission is only paid when the bid is successful, and 2. The entity expects to recover these costs through future revenue. Both Workday and Salesforce state that sales commissions earned by their workforces are amortized over the non-cancelable subscription period of the contract. Suppose, however, that a company's historic experience indicates that a high percentage of the subscriptions will be renewed. Shouldn't the commission on the original subscription be expensed over the entire expected life of the subscription service, including the expected renewals? Well, the answer is not clear-cut. If employees do not earn an additional commission on the renewed subscriptions, then the deferred commission should be expensed over the entire expected life, including expected renewals. If employees do earn additional commissions on the renewed subscriptions, however, then the life over which the deferred commission is expensed depends on whether the amount of the renewal commission is commensurate with the amount of the original commission. As you can see, the fun just never ends in accounting. So what did we learn in this video? First of all, we already knew that revenue from subscription contracts, technical support, license updates, and other future services is initially recorded as deferred revenue. We also knew that the deferred revenue is recognized in the income statement as the service is provided to the customer. So in this video, we learned that Silicon Valley companies often pay sales commissions relating to contracts that defer revenue into future periods. In these cases, companies will record an asset titled deferred commissions that is expensed over the period that the company expects to earn revenue from these contracts. This treatment is consistent with the matching principle, which states that companies should record expenses in the same period as the revenue to which it relates. Well, thanks again for listening. Please stay tuned for more videos concerning the financial reporting practices of Silicon Valley companies.